Today, we're digging into Cellnex, the undisputed king of telecom towers in Europe. Now, after years of this absolutely explosive debt-fueled growth, the company has hit a massive turning point, and that's created a really fascinating and critical debate for investors. And that brings us right to the heart of the matter, the core dilemma for anyone looking at Cellnex today. After this dramatic fall from grace and a complete 180 on its strategy, is this stock a deep value opportunity, or is it a classic value trap? Let's jump in and try to figure that out. The best way to really wrap your head around Cellnex is to think of it as a story in two very different parts. Chapter 1 was the swashbuckling aggregator, borrowing tons of money to buy up tower assets all across Europe. But that era is over. We are now firmly in Chapter 2, the disciplined operator. The focus now is all about squeezing more value out of the assets they already own, paying down that mountain of debt, and finally returning cash to shareholders. All right, so let's start with the bull case. What's the argument for getting excited about this new, more buttoned-down Cellnex? Well, it all starts with the company's incredibly powerful and, frankly, remarkably resilient business model. At its core, Cellnex is what's called a neutral host tower co. Now, that sounds a bit jargony, but think of them as a landlord for mobile network operators, the Vodafones or Oranges of the world. Instead of every single operator building their own expensive tower, they can all just rent space on a single Cellnex tower. It is a simple, brilliant model that makes the whole industry way more efficient. And this business model is just so attractive because it's built on three incredibly powerful pillars. First, you've got these super long-term contracts. We're talking 15, 20, sometimes even more years. That gives you fantastic visibility into future revenues. Second, most of these contracts are linked directly to inflation, which is a huge built-in protection for their cash flows. And third, and this is the real magic, the operating leverage is massive. See, the cost of adding a second or third tenant to a tower you already own is tiny, so almost all of that new rent just drops straight to the bottom line. It's beautiful. And the demand for these towers? It's not just stable, it's actually speeding up. Europe is still playing catch-up on its 5G rollout, which means they need denser networks. We are all using way more data on our phones, and here's the kicker. European towers have fewer tenants on average than US towers. That gap? That signals a huge runway for highly profitable, organic growth just by adding new customers to the towers they already have. And this is really the essence of the bull case. This whole next chapter strategy is perfectly designed to capture all of that organic growth. The company isn't out there hunting for big deals anymore. It's laser focused on maximizing the cash flow from the 130,000 plus sites it already owns. But, of course, it's not quite that simple, is it? Let's flip the coin and look at the other side of the ledger. We need to understand the major headwinds that absolutely hammered the stock and created this whole debate in the first place. Okay, the problem really started with what you could call the macro tsunami of 2022. Cellnex's entire Chapter 1 growth story was built on a foundation of cheap debt. When central banks slammed on the brakes and hiked interest rates at a historic pace, that foundation just crumbled. Overnight, the whole M&A model became completely unsustainable, and that's what forced the company into this dramatic pivot. And the market's reaction? Oh, it was swift and it was brutal. The company's valuation, which is really a key measure of investor confidence, it just collapsed. It fell from a crazy high multiple of over 50 times its earnings at the peak, all the way down to just 17 times by the end of 2023. Investors aggressively repriced the stock, basically punishing the company for having so much debt in a new high-rate world. So this leaves investors today with three key risks to really think about. First is mobile network operator consolidation. As big players like Orange and Mas Mobile merge in places like Spain, they could get rid of redundant towers, which means fewer tenants for Cellnex. Second, even though a lot of its debt is at a fixed rate, there's still a risk when it's time to refinance. And finally, there's execution risk. Look, management has made some pretty big promises about efficiency. Now they have to actually deliver. Okay, so that really brings the bull and bear cases together, right? And it leads us to the single most important question for any investor looking at this company today. And here's the thing. We can already see that the new strategy is delivering real, tangible results. Just look at the free cash flow line on this chart. In 2022, the company burned through over €1 billion. Just 1 year later, it generated a positive €150 million. That is a massive turnaround, and they hit their 2024 target a full year ahead of schedule. And this isn't just a one-off thing.
Organic growth is still strong, and crucially, management delivered on its promise to de-risk the balance sheet. They earned a coveted investment-grade credit rating from S&P, also ahead of schedule. These actions go a long, long way in rebuilding credibility with the market.
But perhaps the clearest signal of this whole new era is the shift in how they handle their cash. The company is planning a large share buyback and has committed to starting a sustainable dividend in 2026. This is a landmark change. It signals a definitive move away from that old growth at all costs mindset to a real focus on shareholder returns. And this all brings us to the really juicy part, valuation. Right now, Cellnex trades at a pretty big discount to its global peer, American Tower. But the really telling comparison might be to Vantage Towers, which was taken private at a much, much higher multiple. This points to a fascinating disconnect. It's like public stock market investors are still hesitant, while sophisticated private funds, who love stable infrastructure, have been willing to pay way higher prices for these exact same kinds of assets. That's a gap a value investor loves to see.
So it all leads to this one final question, doesn't it? Management has pivoted the strategy, they've strengthened the balance sheet, and the cash is really starting to flow. The turnaround seems to be working. So is it possible that the market, after punishing the stock so severely, is now underappreciating the durable, predictable cash flow machine that this new, more disciplined Cellnex is becoming?